short-term fund, like we started last week. We ended up with that affect the choices of a banker. Hello? Hello? Hello?
Hello, sir. Good evening.
Are you hearing me?
Yes, sir. Yes, sir.
Yeah, we can hear you loud and clear.
Okay. Okay. We were sources of short-term funds. Am I right? Okay. Now, do you have any questions from what you have done? Otherwise, we're going to leasing, and the rest of them. Leasing as a source of fund. Go through what you have studied and see whether there's any confusion anywhere so that we can iron them before we continue. Go through. Go through. Go through. Go through. You've done marketing of commercial papers, characteristics of bank loans, hello? Account receivable financing. What is account receivable? What is account receivable? You can sell on credit, as we have studied. Then, when you buy on credit, it's account payable. Account payable. For the seller, it is accounts receivable. So the purpose of this method is to secure the debt and perhaps use the paper to secure funds through either factoring or pledging. When the sale transaction is finally consummated, it is recorded as account receivable. There are two methods or two forms of accounts receivable financing. One is factoring, the other one is pledging. Factoring and pledging. So let's look at factoring receivable. Another source of short-term fund for a big corporate entity involved in merchandising is to sell its accounts receivable to a company that specializes in buying them. These specialized companies are called factors. Please note that. The specialized companies are called factors. They are called factors. And this procedure is called factoring. The specialized companies that buy receivables are called factors. And this procedure is called factoring. We now have to look at factoring procedure. Under a normal factoring arrangement, when the firm receives a credit sale order, it forwards the order to the factor that performs a credit check. In other words, before the factor buys receivables, it must do a credit check. If the factor refuses, that is, if after the credit check it refuses, the seller may sell but bears the credit risk. This is a situation where the seller sends the credit to a factor to analyze. The factor will do its job, and if the buyer is a high credit risk, then the seller may refuse. But if he decides to sell, it will then bear the credit risks. If the factor approves the order, the goods are shipped. If the factor approves the order, the goods are shipped. The factor agreeing shows that the buyer has good reputation and therefore can honor its obligation or promise to pay as and when due, all things being equal. The goods now belongs to the factor. The goods now belong to the factor. The selling firm will draw up an invoice, get it stamped with instruction to remit payment to the factor. In other words, if after checking and the company that wants to purchase the commodity has good credit rating, then the selling company will ship the goods and now draw up an agreement, a sort of invoice, stamping it and with instruction to remit payment to the factor. When payment is made to the factor, then the factor remits the money to the selling firm, less the factoring fee. Less the factoring fee. I did not say less the factoring commission. I say less the factoring fee. It's a business based on fee, not commission. Should a situation arise where the selling firms need immediate payment, the factor pays the firm the amount of the receivable. The factor pays the firm the amount for the receivable, less the factoring fees. Less the factoring fees. B, interest on the advance, because the firm is receiving payment before the factor from the customer. 3, a reserve the factor sets aside for bad debt losses. In other words, the factor will pay, collecting its own fees, then interest for payment in advance, and a reserve for bad debt losses, possible bad debt losses. So it's not going to pay the selling firm the entire amount. It will make some deductions based on A, B, and C. The size of this reserve depends on the factor's opinion of the quality of the receivable. With high quality receivables, the factor may advance up to 80% or more of the invoice value, keeping 20% or less as reserve. With low quality receivables, there may only be a smaller percentage advance. The factor owns these receivables and cannot look up to the selling firm to recover any bad debt losses. When the customer pays for the shipment, then the factor remains reserved to the firm. After payment of the shipment, the reserve will be remitted to the firm. There are essentially two cost components involved in factoring. Please note this. There are essentially two cost components involved in factoring: commission and interest on any advance paid to the firm. Depending on how risky the factor feels receivables are, the commission will usually be a percentage of the invoice value. Then, the interest rate on payment depends on the prevailing interest rate level, but it will be above the prime rate. It will be above the prime rate. What then is the prime rate? The rate at which CBN lends to its most creditworthy customers. The authorized rate for banks to lend to its most creditworthy customers. Refer to the reference textbooks and look at the merits and demerits of debt factoring as a source of fund. Then, the second method of account receivable financing is pledging. Pledging receivables refers to using accounts receivable as collateral for a loan. Pledging means using the account receivable as a collateral for a loan. Unlike factoring, the legal ownership of the receivable remains with the selling firm. Unlike factoring, the legal ownership of the receivable remains with the selling firm. In essence, the lender is buying the receivables with recourse. If the receivables turn out to be uncollectible, the lender can turn to the firm to make good the loan. Notice the difference between factoring and pledging. If you pledge as collateral, the goods still remains that of the selling firm. Under factoring, the good remains that of the factor. Pledging procedure. A contract setting for the legal rights of the parties is agreed upon. There has to be papers to be drafted, agreement to be drafted, a contract setting for the legal rights of the parties is agreed upon. The firm takes its invoice to the financial institution or factor, where they are reviewed and accepted or rejected otherwise. Upon acceptance, payment is made to the selling firm. When the buyer of the goods makes payment to the firm, the proceeds are turned over to the factor. I repeat, a contract setting for the legal rights of the parties is agreed upon. Otherwise, you draw some legal papers, discuss them, agree. Then the firm takes the invoice to the financial institution or factor where they are reviewed and accepted or rejected otherwise. But if it's accepted, payment is made to the selling firm. When the buyer of the goods makes payment to the firm, the proceeds are turned over to the factor. What are the advantages of account receivable financing? What are the advantages of account receivable financing? One, it is a flexible method of financing. It is a flexible method of financing. The level of financing increases with increase in sales. That is why it's flexible. The level of financing increases with increase in sales once the arrangement has been made. Secondly, the security provided may make financing possible. Then, factors provide the services of credit departments. The major disadvantages are when invoices are numerous, administrative costs are too high. This type uses liquid assets as collateral, which reduces its liquidity, thereby endangering its creditors. 3, there is a long-standing reluctance to use factoring because it has been traditionally perceived as a sign of financial weakness. Most firms do not use the opportunity of this financial source because they are perceived to be weak. Then the next source we are going to look at is customer advance payments. Customer advance payments. Some companies, as you know, obtain short-term finance by asking customers to make advance payments before goods are supplied. Sometimes these payments are made because the customers are fearful that if no advance payments are made, the company will fail to supply the goods. And the other goods may be difficult to source elsewhere. Other arrangements are more a better of a standard industry practice. After receiving the advance, the company uses the money for productive activities instead of borrowing from other sources. So advance payment is a source of fund. Some companies utilize that very well. They make sure that you pay in advance, and they tell you when you're going to collect the goods. They will not keep the advance. They use it to go into further production. They use it to go into production, so that by the time they finish, they tell you the day to come and collect your goods. So we have x-rayed and examined various sources of short-term fund. We will now move into medium-term sources, one of which is a hire purchase. Hire purchase. By definition, hire purchase involves a system where money is paid for goods by means of periodic installments with the view of ultimate purchase. You are paid in advance periodically, but your major aim is to purchase the commodity. You must have been hearing the word and have seen people enter into such agreements, but you do not know how it operates. Nowadays, a lot of motorcycle, or what you call tricycle, or in our own area, you call them keke. Okada and the rest of them, they enter into hire purchase agreements. Even these short vehicles you are seeing right now on the road, that carries seven passengers before COVID, because right now they carry 5. You buy them through hire purchase. So this is an indirect method of financing. You obtain the goods instead of money. You obtain the goods instead of the money. The hirer simply reaches an agreement with the seller to pay the first installment, and he'll be using the goods or the item while making the agreement, the agreed installments as and when due. The installment payment consists of the principal, the interest, and the service charge. The instrumental payment consists of the principal, the interest, and the service charge. How does it arise? The principal for the goods, the interest for the advance payment, and the service charge. So whenever you're entering into a purchase agreement, you know that you have 3 cost items to grapple with. The question is, if the hirer fails to pay the installment along the line, what happens to the goods and the amount already paid? The answer is that the seller will collect the goods, and the amount the hirer has paid will be regarded as what he had paid for hiring the item. There's not going to be any refund. The amount paid in the interim is regarded as amount for hiring the goods, while the seller of the goods will take his commodity. The good becomes the property of the hirer only when all the installments have been paid. On the payment of the last installment, the customer or hirer becomes entitled to exercise an option to purchase. Until this option is exercised, the goods remain the property of the supplier. Usually, this option is to pay a small nominal sum with the final installment. No security is required to secure this agreement. No security is required to secure this agreement. Many businesses have acquired vehicles, equipment, machineries, and other fixed assets through this arrangement. Hire purchase agreements, therefore, enables a businessman to acquire an asset without negotiating for a loan or paying cash for it. This major disadvantage is that, one, the interest charge is usually very high, and this continues on the full amount throughout the period covered. 2, the prices are usually higher than when payment is made on cash. Then, should the hirer fail to pay the periodic installment, he will forfeit both the asset and the payment already made. So once you're entering into this agreement, you must be careful, you must be sure, you must have analyzed the situation to make sure that you'll be able to pay the periodic installment. You also compare it with a situation where you can go and borrow and purchase the goods. You can leverage it. Compare the market rate and what you are paying for the commodity. That will help you to reach a good decision on whether to purchase on hire or pay for cash. Usually, the hirer has the interest and the service charge. So the entire thing so that whenever it's divided for the number of periods you want to pay, then you see effectively it may be higher. Next one is commercial bank loans. Commercial bank loans. We call them medium-term commercial bank loans. Commercial banks also offer medium-term loans to businessmen, customers who have genuine desire for expansion of their businesses can obtain loans from banks. The borrower pays interest on the total amount advanced. When the period of the loan extends over an accounting year, we say it's medium-term finance. Medium-term. Short-term is within a cycle, a 1 year, it gets to medium-term. The major source we are going to look at is equipment leasing. Equipment leasing is very, very important. And I want you to mark the terms we are using. Equipment leasing. Leasing is defined by the Equipment Leasing Association as a contract between lessor and lessee for hire of a specific asset selected from a manufacturer or a vendor of such assets of the lessee. Note, the word hire is here again. The word hire is being used here again, but you must know the difference. A lease is a contractual relationship through which the possession, right to use, and the right to control over an asset is transferred from its bona fide owner, that is the lessor, to the user, the lessee, in consideration of the periodic rental payment called the lease premium. The lease premium. The hirer pays the lease premium. The hirer pays the lease premium. So, know the difference between leasing and lease. Then lease premium. It is a means by which a firm can acquire the economic use of an asset for a stated period of time. That is lease. Through this method, the lessee substitutes periodic lease premium for a lump sum that will have been required for outright purchase of the asset. The lessee doesn't have the assets. The lessee needs the assets. The lessee doesn't have the money. He goes into agreement with the lessor, that is the owner of the equipment, for lease premium instead of outright purchase. The lease premium. Through this method, the lessee, who is the user of the asset, substitutes lease premium for a lump sum that would have been required for outright purchase of the asset. The company or lessee never becomes the owner. The lessee never becomes the owner unless another agreement is entered into to that effect. The lessee doesn't become the owner of the asset. He pays lease premium. The hirer pays the renter until the final installment is paid and option is exercised. But in lease contract, the lessee never becomes the owner. In other words, the major difference between the lease and hire purchase is intention to own. Intention to own. Intention to own. There are many forms of lease contracts. One of such is a finance lease. A finance lease. Please know the difference between a finance lease and an operating lease. A finance lease. What is a finance lease? It's a non-cancelable contractual commitment. It is a non-cancelable contractual commitment on the part of the lessee, to make a series of payments to a lessor for the use of the asset. Lease is another form of fixed interest finance, just like debt. Once you agree, you must honor it. It's fixed interest. The arrangement is normally set out in a contract document stating the terms such as amount of periodic payment, period covered, options to purchase, and maintenance agreement. Maintenance agreement. Who maintains? Is it the lessee or the lessor? Who maintains the equipment? Is it the lessee or the lessor? All these gives rise to varieties of lease agreements. Let's look at forms of lease financing. One is direct leasing. In direct leasing arrangement, the piece of assets under consideration belongs originally to the lessor. The lessee will go and lease. The other one is sale and lease back. Sale and lease back. In direct leasing, the equipment belongs to the lessor. But in sale and lease back, which we are going to look at now, you find out the difference. It is an arrangement whereby a company sells an asset it owns. A company sells an asset that it owns to an investment company and enters into agreement with the company to lease it back. Sale and lease back. So by so doing, you sell and get money, and since you still need to make use of that asset, he enters into agreement to use it. You sell it to the company, you enter into agreement with the company to use the asset. Sale and lease back. In other words, the leasing company collects the market price of the asset and pays its periodic renters during the lease period. The purchaser or the lessor will receive the rents and have ownership rights over the residual value of the asset. The next form is leverage leasing. Leverage leasing. In leverage leasing, the lessor borrows part of the purchase price of the asset and leases it out. In other words, you can go to a financial institution, borrow some part of the money, purchase the asset, and lease it out. The loan is secured by a mortgage on the asset. And since the value of the asset falls over time, the lender has to obtain title over the lease and lease payments. To avoid story. We have direct leasing. We have lease and sale and lease back. We have leverage leasing. Advantages of leasing. Lease financing is provided in Nigeria mostly by merchant banks. A company that cannot afford the price of some fixed asset can therefore make use of such assets under lease contract. The popularity of leasing has continued to increase because of some benefits, which leases, lessors, and manufacturers of leasable facilities derive from the arrangement. This arrangement may be the most effective, if not the only way, for securing a market for very sophisticated equipment. With leasing, a lessee can choose from among a wide variety of equipment. Consequently, facilities which are needed seasonally or which are not likely to be fully used, if bought, are best suited for lease. They're best suited for lease. Other attractions include the fact that it allows a company or lessee to receive its fixed assets without having to worry about the problems of obtaining the necessary capital. Also, the rental charges could be set off against profit for the purpose of taxation. In other words, it is tax deductible. These payments are tax deductible. I repeat, they are tax deductible. Lease preserves liquidity since it is not regarded as borrowing. It preserves liquidity. Periodic rentals remain constant, unlike that of other sources of short-term loans, which can be withdrawn with changes in economic conditions, thus forcing the sale of assets. A lease cannot be withdrawn unless the terms of the lease are broken. Cannot be withdrawn unless the terms are broken. So it is secure. The major disadvantages are the rental charges are paid yearly, whether there is profit or not, because it's a fixed charge. Also, the asset will not appear in the company's balance sheet because it doesn't belong to the lessee. It belongs to the lessor. So you can only offset the payment. But you cannot, in your balance sheet, say that you have such assets because it doesn't belong to the lessee. Financial institutions are unwilling to lend money to the company because it is considered as being financially weak. Cumulative cost of leasing a piece of equipment which is to be used to its terminal life is higher than its purchase cost. For using the equipment to its terminal value, well, you have to pay higher because interest is there and the service charge is also there. Let's look at mortgage. By definition, mortgage is a pledge of designated property as security for a loan. Under a mortgage, a business wishing to extend its plant capacity can borrow funds from a bank or finance house and use a real property as security for the loan. That's the mortgage. The arrangement allows a business the opportunity of obtaining funds for expansion. The disadvantage, among others, is that the bank often exercises control over the use of the mortgage property. You will get a more detailed treatment of mortgage under long-term sources. So we will not overflog it here. Under long-term sources, you know more about mortgage. We'll quickly enter into section 3 and look at long-term sources of business finance. In that case, we'll be considering ordinary share or common stock, ordinary shares or common stock. We're looking at financing with rights, that's rights offering. We look at preference shares. We can look at retained earnings and depreciation as internal source of funds. Then debt, outright debt. Outright debt. In other words, cash flow debentures, outright debt. Among the long-term sources we want to look at are issue of shares, shares of ownership, issue of shares, ordinary shares, or what we call common stock. Look at rights offering, financing with rights, issue shares to those that already own shares of the company, financing with rights. Then the other one is preference shares. Preference shares, there are many types of preference shares. Sometimes we call them preferred shares. They are preferred to what? Common shares. They are preferred to ordinary shares. Look at retained earnings, what you call retention. Sometimes it's a planned back profit. We can also look at depreciation as internal source of funds. Depreciation, internal source of funds. Retained earnings and depreciation. Then look at debt. Debt. These are sources of funds that will last for a very long time, and some in perpetuity. And some in perpetuity. Each source has its advantages and disadvantages, and the circumstances that it may be more beneficial to use than others. It's recommended that you should look at and grasp this fully as a basis for thorough understanding of other activities involved in corporate finance. This session is very, very important, and we'll spend a little more time so as to make it sink. Financing with ordinary shares, or what we call common stock. We'll take it bit by bit. We'll take it bit by bit. By definition, a share is a fixed part of the company's capital. A share is a fixed part of the company's capital. From the legal point of view, a share may be defined as interest which a shareholder has in a company, and it is measured by a sum of money for the purpose of accompanying the shareholder's liability and in ascertaining the amount. Many companies use only ordinary share capital to run their companies. Others use a combination of debt and equity. Such combination is very good because the firms enjoy the advantage of leverage. If the firm is a going concern, it can combine equity, debt, and internal sources. Internal sources are retained earnings and depreciation. If the firm is a going concern, that is, if it has been in business, it can combine equity, debt, and internal sources. Let's look at ordinary shares and what makes it an attractive option for exclusive usage. In ordinary shares, what we call common stock. This person is a shareholder. That person is this or that. What do you mean by shareholder? What do you mean by shareholding? Let's look at characteristics of ordinary shares that makes it very attractive. Characteristics of ordinary shares that makes it attractive. Ordinary shares are issued in the denomination of 1 naira, denomination of 50 kobo, as the case may be. And it is required by law to be so. it is issued in denominations, and the law requires it to be so. This face value is called the nominal or par value. If it is 1 naira, the face value is 1 naira. The par value is 1 naira. The nominal value is 1 naira. If it is 50 kobo, the face value is 50 kobo. The par value is 50 kobo, and the nominal value is 50 kobo. This authorized or nominal value is very different from the market price. It may be higher than the market, lower than the market price, or the market price may be higher. The market price is the price at which the share sells and the stock exchange. The market price is the price at which it sells in the stock exchange. It may be more or less or equal to the nominal value. It may be more or less or equal to the market value. It may be more or less or equal to the market value. What determines the market price? Very important. What determines the market price of a share? Here we have 6 factors that affect the market price of a share. 1 is the demand and supply of the share in the market. The demand and supply of the share in the market. We all know that supply and demand determines price. Supply and demand determines price. B, the dividend payout. Does the company pay dividend on the shares? If they pay dividend and of a higher amount, the price will go up. C is retained earnings. Retained earnings. They make profits, retain earnings more, which they use for future expansion. The price will go up. The 4th one is the firm's investment decisions. The firm's investment decisions shows on the profit figure. They make good investments, operate efficiently, they make profits. 5 is quality of management. The quality of management, when a good manager takes over, the price of the shares will rise. Then, investor general expectation about the performance of the company. The investors' general expectation about the performance of the company. So, we're still on 1, the denomination of ordinary shares, and the distinction between nominal price and market price, and the factors that affect the market price of a share. We mentioned 6 here: the demand and supply of the share in the market, the dividend payout, the retained earnings, the firm's investment decisions, the quality of management, and the investor general expectation about the performance of the company. 2, second feature of ordinary shares, it will be offered at par, that is a price equal to its nominal value. It will also be issued at a premium. Premium means above the par, above the normal value, or at a discount. That is in an unusual circumstance. where the price is less than the nominal value. Most often, well-established companies issue shares at a premium. They issue shares at a premium. In that case, you find 50 kobo shares selling at 1 naira, 2 naira, 3 naira, 4 naira. They are issuing at a premium. That is the issue above par. They are issuing above par at a premium, a price above the nominal or face value. A price above the nominal or face value. They are issuing at a premium. However, the Securities and Exchange Commission generally frowns at issues at a premium, at a discount. It's not usually allowed for shares to be issued at a discount. The third feature, by law, ordinary shares cannot be repaid. In other words, they last in perpetuity. Ordinary shares cannot be repaid. Holders can only dispose of them to an interested third party in the stock exchange. If you no longer want to hold the shares, you go to the exchange and offload and collect cash. Sell it to another person. It cannot be repaid. If it is repaid, the company will die. This helps to maintain the continuity of the business as a legal person. If we pay, it will die. Should ordinary shares be redeemable, the validity of the legal entity concept becomes questionable. If ordinary shares are redeemable, then the validity of the legal entity concept becomes questionable. In other words, it's no longer a legal entity. It will die. The fifth feature, ordinary share has a claim upon the company's assets on winding up because they are the real owners of the company. They have claims upon the company's assets on winding up. If the company dies, if the company folds, then ordinary shareholders will have claim on the company's assets. This right is subject to the availability of anything to claim. A company which on winding up has little or nothing left after satisfying the claims of the creditors will leave the ordinary shareholders empty-handed. Yes, if they don't have anything left after satisfying the claims of the creditors, the owners will go empty-handed. The sixth feature, ordinary shareholders have voting rights. Ordinary shareholders have voting rights. In other words, in the company's annual general meetings, they go and elect board members. They have voting rights. In everything voting in the company, ordinary shareholders have rights to vote. They have the right to vote on major issues affecting the company. Ordinary shareholders have the right to vote on major issues affecting the company. The voting strength of a shareholder depends on the quantity of ordinary shares he holds. The voting strength of any shareholder depends on the quantity of ordinary shares he holds. That is the level of his ownership. Voting is done during the company general meetings to elect board members, to pass resolutions, or such other matters that require the approval of members. Rights of common stock holders. If you're a shareholder, an ordinary shareholder, you have rights. There are two types of rights. One is specific rights, one is general rights. Specific rights and general rights. Among the general rights include right to make charter amendments if changes are approved by the Register of Companies. This may involve amendments in the authorized capital or alterations in par value of shares. That is general rights. 2, right to adopt and amend bylaws, elect the board members. The board of directors constitutes the governing council of any company. The board of directors constitutes the governing council of any company. So the shareholders have rights to elect board members. They are elected by the shareholders to run for a specific period. However, members could be re-elected after each term or tenure in office. Another original right is right to authorize the sale of fixed assets, right to ratify mergers and authorize acquisitions, and 5, authorize issuance of preferred shares, debentures, and other securities. It's the ordinary shareholders that have these general rights. Among the specific rights are right to vote as prescribed by the corporate charter, right to vote as prescribed by the company charter. Ordinary shareholders have right to vote. They have right to transfer stock to another party, that is to sell their ownership. They have right to inspect the book of the company. They have right to share in the residual profits and assets of the company on liquidation. They have a stock certificate as evidence of ownership. Then they have the right to subscribe to additional shares in proportion to existing ownership, that is financing with rights, right offering. And the next one is right to take the company to court to prevent illegal corporate activities. They have a right to take the company to court to prevent the company acting ultra-virus. Right to dividend is subject to the decision of the board members. Right to dividend is subject to the decision of board members. Please note it, it's very important. Right to dividend is subject to the decision of board members. In other words, board members may decide to pay dividend or may retain 100%. It's either they pay a portion and retain a portion, or they retain the entire thing without payment. And there are circumstances under which it is better to retain than to pay. And there are circumstances under which it is better to pay than to retain. We shall examine them as we go along, and it is very, very good. Don't worry, we shall end shortly. Just give me some 5 minutes. Give me 5 minutes. I want to take it easy because these are areas where we draw our multiple choice questions. So you have to be very careful. Right to dividend is subject to the decision of the board. Companies' charters are very clear on how profits are to be treated, either retained or distributed as dividend. A decision of a company's board to distribute dividends to the shareholders is usually formalized by the adoption of a resolution stating the amount to be paid, the due date, and the date on which a list of the stockholders who are to receive the dividend will be taken from the stock records. That is, when the shares will go ex-div, ex-dividend, without dividend, cum dividend, and the rest of them. Please note, ex-dividend, cum dividend, stock records. These are very important terms. In the absence of such a resolution, no dividend will be paid. Should the stockholders be dissatisfied with the proportion of profits are appropriated for dividend purposes, a new board will be elected that will ensure generous dividend payments. As a result of this, most companies pay out dividend yearly, whether the profit figure justifies that or not. No board member wants to leave. So if dividend payments is going to be a problem, they will pay dividends. They don't want to be voted out. All right. Most inventors buy common stock in order to gain or ensure the ability to choose all or a majority of board members. Many wealthy Nigerians do have this objective. The underlying reasons may be to one, gain executive position. This happens when a controlling shareholder recommends his son or relation for appointments or employment. The key officer in charge may have little or no leeway. If it is a small struggling company, his withdrawal or unloading of the shares will cause problems in the market. So major shareholders are taken care of because they have a serious executive positions. The second major reasons why most Nigerians own controlling shares of companies to influence contracts. The next one is to determine operating policy. To determine operating policy is very, very important. To determine operating policy. Let's briefly look at the nature of voting rights. Picking the terms I'm mentioning, they're very, very important. Nature of voting rights. That is where we're going to stop. For each share of common stock owned, the holder has the right to cast one vote, one vote, one share, one vote at the general meeting. Where a holder is not able to attend the general meeting, he can vote by proxy. Voting by proxy. Voting by proxy. What is it? A proxy is a transfer of the right to vote. That is asking someone to vote on your behalf. That is proxy. The Securities and Exchange Commission usually supervises it because management can perpetuate itself through the proxy mechanism. They can purchase as many proxies as possible with exercise in their own favor. Proxy voting has a special advantage and a special disadvantage. So let's look at the disadvantage. One, a small group of stockholders can get special advantage through proxy. They go and bribe people, they go and collect votes and vote on their favor. In other words, they continue to remain in the board, irrespective of the feelings of others. So that is one of it. Proxy voting has a special disadvantage because a small group of stockholders can gain special advantage through proxy. This is mostly in situations where the greater proportion of the shares outstanding is being held by a small group of investors who now try to dominate decision making through voting in any direction it favors, irrespective of the feelings of other stockholders, who may have been more in number but scattered throughout Nigeria. It has a very serious problem in Nigeria. It has a serious problem in Nigeria. It has a serious problem in Nigeria. Voting by proxy. Voting by proxy. You go and bribe stockholders who are scattered throughout Nigeria. Well, somebody may have 5 shares, 10 shares, 20 shares, 40 shares, and you have major shareholders. If you cast one vote, it becomes 50%, it becomes 30%, it becomes 20% of the entire, amount of shares outstanding. So those ones that have small number of shares, they do not attend meetings. They do not attend meetings. They ask me to vote on their behalf. So for the fact that one has collected as many shares as possible through proxy, adding it to the ones he has, he still maintains his position in the board and to protest whatever decision he likes. He wants to make a decision he likes because for the fact, as a major shareholder, the other ones may not be able to challenge whatever he has decided on. That's a major disadvantage of voting by proxy. And today, that is where we're going to end. And next week, we'll continue. Hello? Hello?
Yeah, we are with you, sir.
That is where we're going to stop for today.
Okay, sir.
Yeah. Thank you very much, sir.
Thank you very much. Next week, we'll
Thank you, sir.
continue. Thank you. God bless.
God bless you, sir. Good night.
Yeah.
All right, good evening, everyone. We shall be expecting Dr. Kali to come up. So I've sent the link to our WhatsApp group. You can find it there by 9 o'clock, starting that class. So I will end this class now. Let me know if you heard what I said.
Henry,
Yeah, I can hear you. Yes. Hello.
yeah, say that again, please.
Huh?
Right, let's go back to the next class by 9. See you over there. Thank you, everyone.
We can't hear you, Henry. Can you speak up, please?
That I've set the link for the next class. Statistics by Dr. Kalu on the WhatsApp group. Can you hear me now, everyone?
Okay. All right, sir. Okay, we had you.
Okay, good. So by 9, we shall be expecting Dr. Kalu to come up to take us on that course.
All right.
See you there. All right.